Welcome back to the Williams Real Estate Channel. Today we are discussing the June 2025 property market update. Apologies for the delay. I've been a little bit under the weather, as you can probably still tell, but we have seen out of June, out of totality now, formerly CoreLogic, 0.6% up for the month of June for the Australian Dwelling Price Index month on month. So the whole market is up over 0.5%. This has been driven by Darwin, Canberra, the two strong markets for the month, followed by Perth with 0.8%, then Brisbane with 0.7%, Sydney 0.6%, Melbourne 0.5%. And Adelaide at 0.5 also. Hobart in a retracement for the month of 0.2. The combined capitals up 0.6. So the overall market up 0.6 and the combined regions up 0.5 for the month. If we now look at the annualized basis, we will see the strongest market for the past 12 months to date has been Adelaide at 8%, followed by Brisbane and Perth up 7%, Darwin up 6%, followed by the combined regions up 5.5%, Hobart up 2%, Sydney up 1.3%, and Melbourne down 0.4% over the last 12 months. But if you have been paying attention on Sydney and Melbourne the recent months, that 12 months to date figure has been reducing as the market is starting to pick up a little bit now in both Melbourne and Sydney. And this is the overall home value index to June 25. The most expensive market at a price point level is Sydney, 1.2 mil, followed by Brisbane, 926,000. Third place, Canberra, with 855,000 median price point. Then Adelaide at 837,000 median price point. Perth with 819,000 median price point, and Melbourne at 796. So screaming value down in Melbourne. We see right now Hobart at 676,000 and Darwin at 537,000. Also, pretty good value in Darwin, although it's a very volatile market, as you'll see in the coming slides. So we use the 18-year land cycle framework as a macro level to work out which market to enter into, which market to sell out of or refinance or add value by way of renovation and development. It is the philosophy of my investing. I invest around the core framework of this cycle, as there's not one property market. As you know, there's many markets, and every metro region, regional town type of property all runs at different stages of the cycle as the cycle plays out. And we are on that blue marker about 12 months away from peak market come 26. Come 27, we'll be entering the next land-driven downturn, which will be like the next GFC or the 91 downturn. So as we go through these next slides, we are sitting on that blue marker equivalent point of time, 2006. So you'll be able to see and gauge at a macro level where each market sits and where they could be heading in the future years ahead based off historical sales data and this 18-year land cycle framework. So with that said, we'll start with the booming markets, as they all tend to be the talk of town. Even though we are no longer buying in these markets, we still keep tabs on them. Brisbane units is away at the races, as you can see, going gangbusters. And like what happened from 2006 to 7, had a good final run and then topped out come 27 or come 2007, 2008, which will be like 2027, 28, and then we'll soften and then go flatline and negative for many years. So hence why it's a market we are no longer buying into. And personally, I'm getting a couple of units ready to sell next year, come peak market. I will be doing a bit of freshen up, renovation work, kitchen, bathroom type of stuff, paint, flooring, run them hopefully to auction, and I will set no reserve. I'll let the market uh, fair market value, but they'll sell probably close to 500, if not over 500,000 vacant and fully renovated. Queensland houses. So I've mixed these up now. I'm going to be rolling out a singular market update of both metro and region. And you'll see I've selected units for the metros and houses for the regions. This is the way I like to invest. I don't typically buy houses in the metros because the price point gets too high and the yields get compressed. You want to make sure you're preserving your capital and getting into multiple assets. So we typically buy units, villas, townhouses in the metro markets and houses in the regions. And then once we get into duplexes, blocks of units, both in region and in metro. So, but typically metros are all individual units because by the time you buy a house, say like in Sydney, multi-million dollars, the value is just not there. I'd rather go and buy a block of units for 2-3 million than buy, say, one house in Sydney for the same price point, or if not higher. So units is where it's at in metros. And if you can resonate with that, happy to help. And you'll see that we'll be running reports of only houses in the regions. I'm sticking to high level now. If you want further details of exactly types of what town, how each individual town's running, or suburbs in towns, or suburbs within a metro, jump on a strategy session. We can unpack, pull your portfolio apart. We can create a sell down plan to then reinvest into next markets if you are across this 18-year land cycle framework. Because as you can see, this is a town in regional Queensland. I'll be also selling out of this town. I've got 3 houses in this town, looking to subdivide to build second dwellings. So they'll have 6 houses to sell come peak market. Come peak market around 2028, 29, it's then due for a downturn, like what happened from 2009, 10, all the way down to 2019. So I would rather sell out of a market like this and put it into another market that's going to boom in the same time frame than hold it through this significant downturn. This is why I say people who are buying into the likes of Townsville will end up losing their shirt if they continue to keep buying into those markets and end up learning the hard way. Regional Queensland can be very volatile, the towns, and they all pretty much have a similar pattern to this. The further north you go, they tend to boom bust heavier. So I've selected a central regional town to give a general gauge of how regional Queensland is tracking. It is away at the races, as you can see, going gangbusters in the final fear of missing out. But that's never a good time to keep buying into that market. That's a good time to add value, renovation, subdivision, development, for sure. Add to your stock. That's what developers do. They buy up in the troughs and they add value during the booms. And then come peak market, there'll be an oversupply as developers release more stock to the market and then the market will go through a downturn. Classic property cycles. It all swings in cycles from undersupply to oversupply. But right now, regional Queensland is going gangbusters. But we stopped buying in regional Queensland in 23, late 23. Perth units again away at the races, going gangbusters, showing signs of losing a bit of steam. And as you can see back in 2006, equivalent point of time, it shot off like a rocket, then topped out, and then went up and down, negative to subdued flatline for many years. So Perth is definitely not a market we're buying in now because you can pretty much get the same price point in larger metros around the country. And it is becoming dangerous to buy in Perth because you can imagine if you bought peak market 2006-7 and then you held it for well over 10, 12 years in somewhat negative equity, especially if you bought new and off the plan type of stock. So buyers beware of the punters out there, the spruikers that are pushing these types of overheated markets. It's never a good idea to get into a market once it's gone from 300 mark to 600, doubled. Once the market doubles, sure, it'll get another 40, 50, 60% maybe. But then once the market softens, you'll lose that final sugar hit. So once the market goes up over 100%, it's never a good idea to keep buying into that market. You want to get in before that solid growth run. Same goes for regional WA. Houses has been away at the races recent years. Came off a trough around 300, now hitting over 600, showing signs of losing a little bit of momentum, but will probably still go strong, like what happened in 2006. But come 2007, it switched off and went backwards for a good 12, 13 years. So again, another region we are not looking to buy in at this stage of the cycle. Darwin units. Darwin's an interesting one. And I'm not a fan of Darwin because history doesn't repeat, but it rhymes. And if we look back at history from 2006-7, it took off like a rocket thanks to the mining boom, and China was developing their construction and property industry like crazy. They had a massive oversupply come 2010, 11, 12, and then they stopped importing so much iron ore and coal and coal seam gas, and then the mines went through a significant downturn, and they end up with those massive ghost towns where they just built like crazy, and then it switched off. And I've worked with a lot of Chinese builders and developers who have worked in China, and it's pretty much a Ponzi scheme in China. Just like in Australia, when you go buy new off the plan, you typically put a 10% down payment. In China, they want 100% upfront, and they typically use that funding to build future projects. So it's a big stack of cards. And where China's at today, economy's slowing. They've got a lot of pressure from the US, hence why they're not in a strong position. So it's not making our minds go as strong as they were historically. It has started to its bull run, but looks to have showing potential signs of reaching a top already and may not experience a significant bull run like what it did pre-GFC and post-GFC. On top of that, Darwin has a bit of conflict already over the Darwin port. China's got a 90-odd year lease. Australia's trying to get rid of them. The US is putting a bid in, so there might be a bit of a dispute over who owns the port. If we end up in a conflict, a World War III type of conflict, Darwin is not in a very good position. History shows in World War II, Darwin, Broome, Townsville, Sydney and Newcastle all got attacked. So you can imagine, especially Darwin, is in a very vulnerable position in terms of a war. And if you look at the war cycle, history shows or history suggests that we're due for a World War III post the next land-driven downturn, just like what happened after the Great Depression from 2000, so from 1929 to 1933, 34, Great Depression, post Great Depression, World War II. Same thing happened for World War One, kicked off from 1914 to 1918 after the downturn in 1910. So we're due for the next land-driven downturn come 27, 28. And if history is to repeat, which I'm sure it will, and it'll rhyme, then we could be set for another global conflict, and Darwin could be in the firing line. So hence why I'm not putting money there. I'd rather put money into Melbourne for the same, if not cheaper, price point, as it's protected. Adelaide units has been going gangbusters, but it is showing signs of a top, just like what happened from 2006-7, and then went through a stagnant flat period for many years. So again, another market we are not looking to buy into at this stage. Regional South Australia has been going strong in recent years, isn't showing signs of losing steam yet, but is due to, just like what happened from 2006-7, hit a top and then went through a more stagnant flat period for a good 10 years. Canberra had a solid bull run in the second quarter of the current cycle, reached the top and it's now started to, it's softened a bit, now started to stabilize, and we'll probably go through a more stagnant flat period. A bit volatile. This is when I guess a developer may release stock to the market, oversupply it. Bit volatile, but more or less will stay in that same range of 600,000 mark, just like what happened from around 2006 to 17, 18. It's stayed in a range of 350, 375 range for a good 10 years before going to that next level. So I can see Canberra units staying in a range of 600,000 for a good 8 to 9 years before going from 600 to 1.2. So definitely no rush on Canberra. Same goes for Hobart units. Had a solid run, came off a trough of 250 in 2015 off the back of Melbourne when people started moving out as they got priced out of Melbourne, took their money out to the likes of Hobart. It then took off the back of Melbourne up to 21, where it went from 250 to 550, topped out, softened, and is now starting to stabilize and start its stagnant flat period, which could look similar to 2006 to 2015, 2016. So again, Hobart units are probably going to stay in that range of 5 to 550 for another 8 to 9 years. Tassie houses, solid run in the second quarter of the current cycle from 2017, 18, all the way up to 2021, 21, 22. Topped out, softened, is now starting to stabilize, and will probably look similar to what happened from 2006-7 all the way to 2017. So we'll be buoyant, but then we'll lose it when the next land-driven downturn sets in the later end of the decade, then go through a downturn, will then come back up again, but won't be for another good, I'd say, 10 years until Tassie houses will then go through another bull run. Regional New South Wales. The regional New South Wales is a tricky one because this is a central town in regional New South Wales. I took just a central town for all the states to give a general gauge. Not every town runs exactly the same. So before you chuck your comments in saying this is not like the Northern Rivers, so the likes of Grafton up to Lismore, Byron, surrounding towns, the 18-year land cycle doesn't know the difference each state, doesn't know that there's been a ruler marker between New South Wales and Queensland. It's an underlying cycle, underlying current, which drives people in and out of certain markets as the cycle plays out. So the likes of Grafton, um, Lismore, Casino, Byron, Mullumbimby are running a similar pace and similar time of the cycle to the likes of Southeast Queensland because it's in that same region, even though it is in regional New South Wales. So those towns up the northern end of New South Wales are still going gangbusters and are looking pretty similar to the pattern of Southeast Queensland. So this is central New South Wales, which topped out in 22, along with all Western New South Wales and South West New South Wales regions, hit a top in the midpoint of the current cycle, had an outperform during the second quarter, topped out, softened, started to stabilize, showing signs of stabilizing. It's hit a trough, come up a bit, and it will look like what happened from 2006-7 all the way to 2015. It will stay within that range of 650 price point for a good 10 years before going through the next bull run in the second quarter of the next cycle, where we'll see it go from 650 to 1.3 million. Regional VIC is showing signs of stabilization, topped out in 22, looks to have reached a trough middle of this year, has started to come up again. But there's no rush on regional VIC at this stage. It's only going to stagnate for the next 3 or 4 years before then starting its growth cycle, which will not take off like a rocket straight away. The regions never tend to do so. They start slow and then they start to run hard once their respective metro has gone up at least 50, 60% from the trough. So people will start heading out into regional VIC once Melbourne has gone up 50, 60% from the trough, which it's at very early stages now, Melbourne. So in, say, 3, 4, 5 years, once Melbourne's going gangbusters, that's when people will start heading out to the likes of regional Victoria as they get priced out. And that's when we'll see regional VIC houses go through a growth run in the second quarter of the next cycle. So no rush. I know there's buyers agents pushing people into regional Victoria already. Probably not a good idea unless if you want to buy a house today and sit on it for 3, 4 years at the same price point. You're not going to get the growth straight away. If you're looking to park money out in a block of units, sure, more of a cash flow play, but you won't get the growth in regional VIC or regional New South Wales at this stage of the cycle, not for another minimum 5 years, if not 6 to 7, 8 years. Sydney units is still stagnating up and down. We've had a bit of a growth run this year. We were buying a few deals early this year, late last year, and it started to pick up, but will probably soften out a little bit and is due to still stagnate for another year or two before starting its next growth run come 2028, 29, 30 in the first quarter of the next cycle. Melbourne units is pretty strong, depending on which suburb region you're looking at. Not all units, not all suburbs are good to buy in Melbourne, especially not in the CBDs. You can lose a lot of money and get caught up. I was talking to a prospective client recently who bought a new and off the plan apartment in the prior boom 2016, 2017 for 1.2 million. I ran the report, current estimated value 800,000. So you got to be careful, especially when you're buying units, to be getting into firstly the right market. You don't want to be buying into an overheated market, and you do not want to be buying a new off the plan type of stock peak market, because that is something that can potentially wipe you out or get you caught and stuck holding an asset for many years and can't do anything. So he's got his hands tied because he bought a unit for 1.3 and it's now worth 800 that he cross collateralized with his family home. So he can't refinance because they want to revalue both of them, and he's in negative equity across two properties. So not ideal. And he can't even refinance to a different bank because once they do the valuations, it's there's not enough skin, there's not enough fat in his property. So he needs to wait for probably another 5, 6 years for the market to move before he can then get out or refinance out of his position to keep growing and moving forward. So a wrong decision has put that person out of the property market for probably at least 10 years. So you've got to be cautious, especially buying units. Not everything works, but some work very well. And as you can see, Melbourne looks pretty resilient in this particular suburb, and it's already starting. So Melbourne units are great. And this is a snapshot of where I see each market across Australia as of June 2025. Adelaide's hitting a top, is due to go through a downturn, followed by South Australia, regional South Australia. Darwin is in the midst of its boom, but looks to be short-lived. It's not going to experience a significant boom like it did pre-GFC and post-GFC, I don't believe. I don't think the mines are going as strong as they were historically, and China's not going to be there this time around to save us. So the likes of Darwin and regional Queensland will go through a heavier downturn than post-GFC last cycle, because the next downturn is going to look like more so of the 91 recession we had to have. And it will be ingrained in everyone's psychology for the next 20, 30 years. It will be the downturn that we'll be telling our kids and grandchildren about. So get ready for it. Don't get caught up in all the FOMO and where all the stupid money's going into Adelaide, South Australia, Darwin, Perth, WA, Brisbane, and Queensland now, because you will learn the hard way when the market turns. The only markets we're really focusing on now is Melbourne and Sydney, because they're in their primed positions for the next growth run. I think Melbourne's already started. It's been harder to buy deals in Melbourne this year than last year. Sydney, probably another year and a half, 2 years away from starting, but this is the best time to buy. All the mainstream herd starts to pour in, because by that time it's too late and we're on to the next market. Regional VIC has stabilized, will start to stagnate out for a couple of years before hitting a trough. Same goes for regional New South Wales, probably a good 7, 8 years away before hitting a trough. Hobart, Tassie, Canberra, good 8 to 10 years away before hitting a trough. But we'll track them. I hope that helps. Hope that resonates with you. If you are looking to buy an investment property, if you're looking to build a portfolio, if you've already got properties, great time to reassess your position. We're 12 months away from peak market, 2 years away from the next downturn. So best assured to reassess where each of your properties sit, because it may not be a good idea to hold them long term, especially when the next land-driven downturn sets in. Personally, I'll probably sell out of all of Queensland and put the money into Sydney, Melbourne, regional VIC, New South Wales, in towns and in metros, getting ready for the next wave. So if you want help, shoot me an email. Happy to jump on a call, run reports, do a strategy session, and help you build your portfolio within the framework of the 18-year land cycle, as you can use it to not only capitalize on the next growth cycles, but also be prepared and protect yourself from the downside risks that come when the market turns. Till next time, hope you enjoy that. Thanks for watching.